the investments market view commentary for Tuesday the 2nd. Good to hear that we're sounding good. All right. We're going to do this in two sections, but first of all, starting off with our normal commentary, welcome to, short answer is welcome to September. It is one of the worst months in the market. Now, of course, there are times when after hours, Apple might be up like $6. And no, we did not protect Apple today, but we are slowly adding protection. Last week, we protected Micron, NVIDIA, Meta short calls for those that are in Meta. We have JP Morgan short calls. Today, we added Meta puts, Bank of America puts. Well, Bank of America now has puts on it, and we're looking at tomorrow, Disney and Apple. But Apple got some news. And actually, I also think, believe it or not, well, it might be a bad day. I don't think we protected Google yet. We've looked at a couple things. Thank goodness we didn't protect Google or Apple. And Google and Apple are up big today, which is pretty interesting because the antitrust, Apple shares rise after decision in Google antitrust cases, and basically Google and Apple both avoid the worst antitrust penalties. So those two are up big, and they're basically going to save us tomorrow. Did we add Google puts today? Dang it. I was working with Kiev. 210s, huh? Well, I guess I should have had this all written down ahead of time, so I knew what I would be talking about. But the good news is we are expecting, even though it's a down month, we are expecting a couple catalysts that normally happen. One of them would be a rate cut. So we are looking for a rate cut. We do think that can happen. And that is something that we are obviously keeping in mind. We filled Google and Bank of America and Meta today. Held off on Apple and Disney. Bad timing, Kevin. So we might be taking the Google off. I'm not sure how we're going to run this exactly. Meta, Bank of America, and Google L was added today. And the interesting thing, Kevin, why did you make this decision? Google, we were trying to protect because it seemed like it was at a top. If you take a look at the Google, it's been overbought for a while. And the last time, what we were looking at, the last time it hit that overbought, we had a drop down. Basically went from 202 to 87. So we saw that 10% happening roughly at the same time here. And that's why we were fearful on Google. So we will see how we're going to rejigger this tomorrow. We will probably go to some short puts where we might even be willing to get rid of the shares at 220, depending on what our credit is. But we're going to create a bull call spread, obviously, and see if we can't salvage where we're at. our next area. The Fed is in play. And the short answer, a lot of people are looking at the Fed and going, what are we doing with the Fed? The Fed is in play, and the Fed right now is our number one catalyst. We plan on looking at Disney and Apple. Okay, great big picture. If you ever want to understand why it matters and what it doesn't, bull steepener, bull flattener, bear steepener, bear flattener, they're all defined in the big picture. It's really an interesting way to look at how important this rate cut will be. A bull steepener, short rates move down faster than long-term rates. A bull flattener, long-term rates move down faster than short-term rates. A bear steepener, long-term rates rising faster than short-term rates. Bear flattener, short-term rates rising faster than long-term rates. Two of those can happen at a time. There's a great explanation on the bull. The 2-year note moving down faster than the 10-year yield and the 30-year yield is known in the Treasury market as a bull steepener trade. Today we'll unpack what that means while shedding light on some of the other trading terms applicable to yield curve dynamics. Playing with the house money, a steepener yield curve up to a point is not a bad thing. Banks enjoy it. This is why we were a little worried about Bank of America and why we're going to protect Bank of America going into the rate cut. Banks enjoy it since they borrow at short-term rates and lend at longer-term rates. Pension funds like higher long-term rates because they reduce the present value of their future liabilities. Fixed income investors like a steeper yield curve since it allows them to lock in higher rates while taking on duration risk. Just some ideas on why people are so excited about a 60-40, but why it's looked so bad for so long in regards to people investing in the 60-40. It's just, it's a very interesting article. Please read through the bearish development where some things are a little out of whack. A couple comments that people have asked me on why we were down today. Is Trump out of line with the federal courts and the executive office responsibilities? And that's really where people are saying, okay, somehow he lost a federal appellate court tariff challenge. And the short answer is, I think he's trying to invoke the 1774 Act, might be the 1974 Act. I need to find out which one it is. 1774, 1974. And people say he oversteps his bounds because there's only a 15% leeway in raising tariffs. The other side of it is it's not his jurisdiction, it's Congress. But that 100% goes against the Constitution. And historical patterns over the last 50 years have made it a presidential responsibility. Now, is this a hate Trump scenario again? Maybe. Does it matter? No. Can someone please tell me why this doesn't matter and why this should be a buying opportunity if we have a big drop in September? Someone come in and tell me, why is this a 100% non-issue one way or the other? And if you don't know, again, you're always welcome just to type a couple question marks in. But why is this a huge buying opportunity? If the market gives up, let's say 10% over Trump Fed court battle. Anyone know? Anyone know why this would be a huge, not a big idea, not important, nothing to worry about? Going once, going twice, going 3 times? Who owns Congress by way of political parties? The Republicans do, right? So, I don't know how I'd say this. Even if he's overstepped his bounds, it will most likely get pushed through the House, and it'll still pass, and everything that's already been done will stay done and in place. So that's our short answer. I had my screen unfortunately paused. So again, going over the big picture, bull steepener, bull flattener, bear steepener, bear flattener. There's some great definitions in here. Please make sure you go through it. But this is, again, why we're going to protect banks going into the rate cut, most likely occurring here 2 weeks from tomorrow. We're still going with lower. We're going with lower, partially because the market headed lower a little bit last week, but because we don't have any real catalysts that are coming up. And because we don't have any real catalysts that are coming up, then obviously we're looking for markets just to take a pause. Historically, this is what they do in September. We are close to going bearish on the S&P. It's really coming close to testing the 50-day. Don't be surprised to see it go down to the 63.25 mark and test it and bounce around it. If you're wondering what that might look like for September, see how Disney is just bouncing around, broke the 50-day, tried to stay above it, came down. This will most likely be our chart pattern for the S&P 500. It would not surprise me to see it break it for a day, come above for a couple days, give up its 3 to 7% pullback, kind of work its way up. That chart pattern is what we're expecting for the month of September into maybe the first couple weeks of October. Disney's last month chart pattern. That is our expectation for the S&P 500. Zero catalyst. Well, what about Apple announcing new products? Well, that typically has been a buy the rumor, sell the news. Well, what about the fact that they didn't have as bad of antitrust issues? Yeah, that normally will help them, but it's probably short-lived. We're expecting that same chart pattern, though, just because it's historical norms. Here we go. We will most likely see that drop through. We'll probably come down to the 6100 S2 level, and we'll work our way back up. That is our chart pattern. That is our expectation. So we are saying bullish today. Yes, we'll get some good news tomorrow, but it doesn't mean that it's going to happen. All right. Very close to the NASDAQ. We're probably expecting that same downward movement on the NASDAQ. It's just had such a good run from 14,784 all the way up to 2,100. It just needs a pause. It just needs a break. Does it need a 10% pullback? Not necessarily 10%, but 21.7 down to the 200-day, 19.7, 19.5 would give it that 10%, making it sound cheap and a run into Christmas. Again, our expectation is it will have a historical bad September, so we're ready to protect accordingly. This September for the whole market, we put 2 in there, but we're probably looking closer to a 3.5 is what we were discussing at Hurley Investments this morning, down 3.5%. Earnings, we have the stragglers, week 3 of retail, Macy's, American Eagle Outfitters, CRM on Wednesday. We have Broadcom, DocuSign, Smith & Wesson, and Lululemon on Thursday. Not a whole lot happening on the earnings cycle, so it's a non-issue for earnings this week. No bellwethers, nothing that'll move markets. On the flip side, we have a lot of economic reports. ISM manufacturing, which will probably move our markets tomorrow. Thursday, ADP employment, even though it sucks, it has been nowhere close to the non-farm payrolls. We're still looking at it. ISM services, unit labor costs and productivity, trade balances in there, but that's a non-issue. Obviously, Friday, non-farm payrolls, private payrolls, unemployment, hourly earnings, and average work week. We do have a couple interesting articles. Again, I'm running through last week's. Here's a stat that stops a lot of people in their tracks. I'm going to go through that in my next presentation. I had someone that sent me a couple market watches. It's funny because I had one of them, but one of them is how Vanguard defends a super conservative strategy that is proving surprisingly conversational. 70% bond, 30% stock setup. It's the newest, hottest thing. I will destroy that in my next presentation here in 2 minutes. And then we also had one, yes, rate cuts will be good for stocks, but here's why it means the Fed will be stimulating an economy that doesn't need it. And they're 100% correct. There is no need for rate cuts other than to stimulate the economy for people that have been waiting to refinance and buy houses. Will a quarter point do it? No. This quarter point means nothing. We just want to see the dot trend look like they're going to cut somewhere between 1 and 1.5% over the next 12 months. That is doing nothing more than helping people refinance or jump-starting the housing market, where unfortunately the majority of America's profits through all our years of hard work sits within a home. For some of us who have been in the stock market, we have some benefit. For those that have run 401ks, it obviously hasn't been very much of a benefit. So it's just something to keep in mind there. And last but not least, I just put another article in here on NVIDIA as it beats the top and bottom lines, just to help you understand why this might be a fabulous opportunity to get into NVIDIA. We'll probably see us, in all honesty, recreate a new bull call. We're hoping And again, I know you should never trade on hope. Thank you for whoever will remind me about that. We are hoping that NVIDIA would, well, let's just bring up a chart to show you what we see. That would be the best. We were looking at a chart. Our hope for NVIDIA was to see it get down to, as it broke the 50 today, but I think it did, nope, finished below the 50. We were hoping to see it get down to our first S2-ish support level at 160. And we'd want to create a 160-200 bull call. If we got it down to 160 and it held 160, we would then run for a taking off the 230s and adding another set of the 180s. You'll notice we took profits, boy, we nailed it on the high side, right up around 182, 183. We took off the 135 200s, booked an amazing profit. We also took off the, what I think they were the 170 200s. And then we went farther out in time, out to March, on 180 230s. So we're now looking to give us the opportunity to reconstruct new NVIDIA trades. Somewhere around 160 200s is what we're hoping, maybe 160 200s. We get down to the oversold level at 30. We're going to put those on relatively quickly. We also are going to take off the 230s and dollar cost average the 180s or 185s. We've got a couple different sets in here, so just giving you a heads up on that. All right, so that's our market commentary for tonight.